Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. In this video, I'm going to share with you guys 7 companies that are still undervalued. If you look at the market right now and you listen to what's happening out there in terms of you're watching CNBCs and so on, everyone is talking about the fact that the overall market is very expensive. And I do agree to a certain extent. But of course, there are still despite all of that, there's companies that are still undervalued. And you remember there's 11 different sectors within the S&P 500. Some are doing really amazingly, like I'll show you in a second. Some are doing not great at this point in time. And of course, the overall market might seem expensive, but if you check under the hood, there's a lot going on. There's a lot of other companies that are doing really well, but right now overlooked by investors. And this is exactly what I'm going to do today, share with you guys 7 companies that are high quality businesses, but right now they are trading below their intrinsic values. And that's what we try to do. We're trying to buy high quality businesses below their intrinsic values right now. So in the future, inshallah, that you can make good money, good returns once everything goes back to the normal. So for example, once everyone realizes how amazing these companies are and they start buying this stock and so on, then at least you're going to make some good money, inshallah. And that's the whole purpose of doing this whole investment thing, right? But let's start with the S&P 500 and where we are. Just general markets where we are right now. So a year to date, so since the beginning of January up until now, the S&P 500 has actually gone up about 13%. The Dow Jones about almost 8%. The Nasdaq about 16-17%, and the FTSE 100 12%, which is really good. Now, but if we get to the end of this year, and this is the returns that we see on the indices, then you will be very happy, because that means we've gained from where we were at around basically February or April this year, once the tariffs was announced. Where we were and where we are now is completely different. And anyone who bought it right at the bottom, congratulations. Okay, anyone who was dollar cost averaging at that point, congratulations. Anyone who sold at that point because they were scared the world is about to end, then they are the ones that lost out. And it happens every single year. We get a bit of a scare moment, moment where something happens and everyone gets scared, and this massive drop happens and everyone is like, oh wow, we're gonna have to sell everything. So on the 8th of April, if you sold everything, you missed out that basically 12, 13, 14%, whatever it is, gains since then. So you have to be a long-term investor and think about the bigger picture. If you look at right now, the fear and greed, this is something I use all the time just to kind of give me an idea of what the average investors are thinking about. No longer we were in greed and extreme greed, but right now we're kind of neutral. So let's see how things go in the next few months. And again, this just sort of indicates where if people are really bullish on buying stocks or not. And sometimes it could be just the also cryptos and the other things, the meme stock. When all of that madness was happening a few months ago, we were here, extreme greed, because everyone was just more, they were very happy to buy these things that have no underlying assets, for example. If you look at the sectors in the S&P 500, this is SPY, as you can see here, year to date, the best performing sector within the S&P 500 is the communication services, and that includes Google and Meta. That's probably why they're doing really well. Then you've got 20% on technology. Again, we know why, because tech has been leading for quite some time. Then you've got industrials, and that's done about 18% and so on. Then you've got utilities that have done well. Financials has been doing well. Energy has actually come back. Consumer discretion is doing about 6-17%. But consumer staples and healthcare are the two sort of that have not done really well. Even since the interest rates has been cut, the real estate has actually now gone in the green, which is about 3% up. So it's quite nice to see that. So when you look at the S&P 500 and you look at the different sectors, there are still opportunities within these sectors. Even within technology, there's companies that have been left for dead. So you're going to have to do your research and find these high quality businesses that no one is talking about right now. And that's what I'm going to do today. I'm going to share with you guys 7 companies that I genuinely think are great companies. Again, I'm not a financial advisor, but do your own research. But these companies, in my opinion, are really good companies and potentially a good buys right now. And once I mention those companies, of course, if you're interested, go away, do your research, and take it from there. And as usual, we've got the similar sort of up and template where we talk about the motive of the company, any dividends that they pay and how long they've been paying that, the profit margin, return on equity, return on invested capital, the free cash flow. We talk about things like the EPS, growth expectation for next year, which kind of gives us an idea of where, if the company is basically profitable in the next couple of years and so on, and if things are heading in the right direction. Same goes for revenue growth and estimate for next year, and then we use Morningstar valuation. Let me stop here and talk about Morningstar valuation. Morningstar is probably one of the best when it comes to their valuation side of things, because not only do they use discounted cash flow models to figure out the intrinsic value for a stock, I genuinely think they are very realistic and they have got some sort of a margin of safety embedded within that formula, because I have not had any problems using their intrinsic value basically, or the fair value price that they use for over the last whatever years. And every time I've actually used that, every time I stayed away from a company, what they've said was actually true. Every time I bought a company because of what they've said in terms of their valuation, I've actually made money. But on top of what they normally say, I still add another 10% just to be on the safe side, another margin of safety of 10% or more. Now let's have a look at the first company, and that one is no surprise. It's a company that I own in the family portfolio, in this portfolio as well. And if you watched my last video, you know exactly what I did. I bought more of this company. Salesforce is a leader in cloud-based enterprise software, especially for customer relation management solutions. They offer tools for sales, services, marketing, analytics, and more. And right now they're pushing to get into the AI side of things in terms of agent force. They bring in basically automation side of things, so they can automate a lot of the tasks these companies require. So there's no human touch, if you like. The AI, the agent force will take care of that. The company has a strong moat, in my opinion. Okay, so it is not easy to change. Once you're in their ecosystem, it's very difficult to switch from them to any other company. For that reason, a lot of companies will stay with them and probably will ask them to build AI and so on. Recurring revenue is another thing which I absolutely love. So that SaaS kind of model, an investment in AI and data basically could also allow them to grow in the next couple of years. So let's see how that goes. They're still in the early stages of kind of embedding that AI into their systems, but once they do, I genuinely think this company will be absolutely fine, and I don't have anything I'm worried about. The only thing that's basically out there is basically the risk of competition, companies like Microsoft, Oracles, and so on. And then you've got, in terms of looking forward, they've raised their full year outlook for basically for 2026. So let's see how things go. And they're acquiring other businesses. They acquire a lot of businesses. So let's see where that goes in the next couple of years. But as you can see right now, it has a market cap of 231 billion. It has a wide moat, like we said in the beginning. They do have a small dividend, and their payout ratio is only 25%. In terms of increasing that dividend, they've only started the dividends, so it's not basically there yet. But the safety is 80%, profit margin of about 17%, return on equity about 11%. What this allows us to do in terms of profit margin, return on equity, return on invested capital, this shows us if the company is profitable, two, if the company management are doing a really great job and using the money, the capital they have to reinvest and to generate more revenues and so on. So that's genuinely important. And we've also got the free cash flow of over $12 billion, which is very important because that's the money the company uses to reinvest in the business. If they want to acquire other businesses, they'll do that. If they want to pay dividends, they will do that. If they want to pay off any debt, if they want to increase whatever they need, they've got cash. They don't have to go to the bank, get money for high interests and all of that stuff. EPS is expected to grow about 12% for next year and revenue about 9%. Morningstar is saying right now 34% upside from where we are. $325 per share is where they think the intrinsic value for this company is, which is interesting. The next one we're going to look at today is S&P Global. This one is, I was very surprised to see this company is actually undervalued at this point in time. $560 per share is where they think the price should be. It's about 15%, should be about 15% higher. They provide financial and intelligence, credit ratings, benchmarks, analytics, data, indices. They work with a lot of companies out there. They power money behind the scenes functions in capital marketing, commodities, markets, and so on. Again, is another one that has a very strong moat, in my opinion, for high switching costs. So it will be very difficult for other companies to move from this company to another company. They have got very diversified across ratings, indices, market intelligence, and so on. And they've got reliable cash flows and subscription-like basically business. So they've got subscription model, which is really good in terms of, once you subscribe, once you're in that ecosystem, again, it's difficult for companies or basically countries, whatever, to move away from this company. One of the major risks is the regulatory side of things. So again, that's normal when it comes to credit rating companies and so on. And exposure to basically economic cycles. So when there's a demand for data analytics, basically depending on whether we are in a boom market and so on, that can also hit the company. And the stock so far has underperformed. In fact, I just want to have a quick look at where they are in terms of SPGI. Let's have a look in terms of year to date, their performance. Yeah, it's about 2% down. So it's not on the lower end of the 52-week range. That was $427 per share, but it's not far off, which is interesting. Again, this is one of the dividend kings out there. They've been, paying dividends and increasing that dividend for over the last 50 plus years. And in terms of profitability, they're one of the best out there. Return on invested capital is not the best, but it's there. Free cash flow over $5 billion. They're expecting the earnings to grow about 12%, revenue about 7%, 15%, like I said, upside from where we are. So another top company that's still undervalued. The next one is EOG Resources. This is an energy company. They deal with oil explorations, productions, and they also basically research and develop, produce, and oil and sell crude oil, natural gases, and natural liquid gases, and so on. In terms of moat-wise, these companies don't have much of a moat. As you know, the entire energy sector is basically quite similar. In terms of some of the risks involved with this company, very sensitive, of course, to commodity prices. Depending on the oil prices goes up and down, this company might be actually, the price will go up and down depending on that. And they've actually beat their latest earnings expected. Basically, they've actually beat their latest earnings reports and so on. And as you can see here, they have healthy dividends of $3.8 billion. They have an excellent free cash flow that covers that. They've been increasing that dividend for the last 7 years, if you like. The 5-year growth rate of 28%. So this is what you call the dividend growth company. Although they're in the oil sector, they are a dividend growth company, and they're expecting the earnings to grow about 12%, revenue about 9%, which is really good. 9% upside from where we are. So another really interesting company that is still undervalued. This is a company that I've added to the portfolio. Equinix is a REIT, and they are global data center and digital infrastructure company. They provide basically the infrastructure that's needed for data centers and so on. So they're not your typical REITs, if you like. I like that because that's the side that when it comes to AI and everything else, all of these companies, they need the data centers, and this is the company to go to. They have a very high barrier to entry, so that whole industry, because to build those data centers is very expensive. Not many companies will want to go into that. So building the data centers in capitals basically is quite expensive, if you like. The growth tailwinds, for example, from cloud computing and AI will help the company, and the computing of 5Gs and 6Gs and whatever. Stable demand for infrastructure, even in digital businesses, is also booming. So they are in the right industry, if you like. They've got excellent dividend, and the payout ratio cannot be over 200. That must be a mistake. I think where the data comes from, sometimes they just put some random data, but that's not. I can't imagine the payout ratio. It's probably about 60. In fact, we can just check that now. We use Simply Save Dividend, and it's about 50% when it comes to that. But yeah, excellent dividend. 9 years of paying that. $18 is what you will get for every share of this company that you own. 86% safety, profit margin, return on equity, return on invested capital. is decent. Again, remember, it's a REIT, and they don't have a lot of cash, but of course, the REITs are expected to pay 90% of basically of their basically profits basically as a dividends. So that's is different to basically any other company, if you like. EPS expected to grow 7%, revenue about 8%, 6% upside from where we are. So another interesting company that you could potentially look into in the next few weeks. This one is not, and when I prepared the video, it was actually almost undervalued at that point, but not undervalued at this point in time. But anything can happen in the next couple of days. So if it goes down 3%, then you will have a fair value stock basically. 155 is what they expect. 159 is where it is now. Top of that, if you add another 5 to 10% of your margin of safety, if you like, you can wait for the company maybe to drop another 7 to 10%, then potentially look into this one. But again, AMD, we all know, we've talked about a lot in with everything that's happening right now with Nvidia. Of course, is in the shadows of Nvidia, if you like, but again, it's a great company in my opinion. They don't have a wide moat, which is interesting for this company. But overall, they're a great company. Competition is a very much with Nvidia as well right now is very high, if you like. But let's see how it goes in the next few months to see what happens to the company. They always perform well despite whatever's happening. Remember, this Intel and this company went neck to neck when over the last whatever years before Nvidia came along, before Intel became completely rubbish, and now they've got Nvidia to fight with. So let's see how it goes. But the lady is in charge of this business. I trust her. She's really good in what she knows what she's doing. The company is in all sorts of industries, and I like the fact that when it comes to gaming side of things, they've got some of the best chips out there. So let's see how it goes. But right now, it's not overvalued, but is not undervalued, but it should be over and undervalued at any time. So it's just 3% difference. Adobe is another one. This has been an interesting one because not many people are looking at this company because they think it's completely dead. But if you look at their revenue, basically their recent report, and go through the report and actually listen to what the company has said, the company is not dead. Far from it. Adobe is a software company, the best known for, of course, when it comes to Photoshops and so on, creative cloud side of things. Yes, there's a competition out there. Yes, AI is a competition for this company. But I don't think this company have a strong brand and ecosystem in the creative software side of things. Many companies will stick with this company for a very long time. And the fact that they've got that recurring revenue, that subscription model is genuinely important to them, because it's not many companies will all of a sudden say, oh, well, let's not use this, let's switch, because everything they've been designing over the whatever years, they've been using Adobe software. So once you eat that ecosystem, it is important. Of course, with AI, there are new tools that are coming up, making things life easier, but they are also investing heavily into AI. So let's see how things go. They've got excellent free cash flow, closer to $10 billion. They're not dead at all. And let's see what happens in the next few months. But right now, 55% upside from where we are. $560 per share. Right now it's about $360. You can't go wrong with this one. And final company we're going to talk about today is Fortinet. By the way, I might sound bullish on some of these companies, but that doesn't mean go away and buy it, because I do own Adobe, I do own AMD, I do own EOGs, and S&P Global, Salesforce. The only one that I actually don't own basically on this list is this one here. So I've recently actually basically sold it, took some profit off the table completely, but again, it's still undervalued 28%. And the reason I sold it, I'll share that with the community on the Patreon account. If you haven't joined us, the Patreon account, please do so. But that was more of a personal reason. It's nothing to do with the company. But as you can see here, they're expecting the earnings grow by 11%, 12% when it comes to the revenue side of things, 28% upside from where we are. One of the best companies out there when it comes to cybersecurity. And you cannot talk about AI. You cannot talk about data. You can't talk about any of these things without taking into consideration the protection that data needs. And when it comes to cybersecurities, these companies are gold. I wish I could buy more of basically CrowdStrike and this company there, but right now CrowdStrike is probably too expensive. So out of all the companies out there, this is the cheapest when it comes to cybersecurity ones. But yeah, 28% upside from where we are to basically 11% growth expected next year, 12% when it comes to revenue. Great company overall. So let's see how things go in the next few months. I probably will be, you will see this company trading maybe 150ish, not from now, in the next couple of years, inshallah. But yeah, that's the 7 companies I wanted to share with you guys. Again, please make sure that you're doing your research. Like I said, I might sound bullish on some of these companies because I am, but that doesn't mean you need to be. You just need to go and do your own research. I'm just sharing what I know of these companies. And again, when it comes to Sharia-compliant side of things, nothing wrong with any of these companies. This information comes from Zoya. They use these standards that are put together by scholars, and of course, this is what they came up with. So have a look at that. Interest-bearing debt for this one is slightly higher because, of course, it's a REIT, and that's normal. But majority of the other companies are absolutely fine. So there you have it. That's the 7 companies I want to share with you guys. There's still a massive opportunity out there. So yeah, sorry making for this video slightly longer than it needs to be. But if you haven't liked the video, please do so. Share it with your family and friends. Comment on the comment section, and let me know if you have any questions. If you own any of these companies and so let me know, inshallah. Have a wonderful day. Assalamu Alaikum.